All right. Well, hello, everyone. We have made it to the end of the first week of Money in Banking. So hopefully this has been okay for you. Hasn't been too painful to be watching me virtually. Maybe it's less painful than watching me live. Who knows? Um, anyway, so today we're going to be talking about the stock market, right? So we're going to be talking about stocks, equity, shares, whatever you want to call them. That's what we're going to talk about. So we're going to talk a little bit about, you know, what's the role of equity in a financial system. We're going to be talking a little bit about how do you price shares of stock, right? The theories of how you price shares of stock. We want to talk a little bit about our markets, stock markets efficient, and what does efficient mean? And then we also want to talk about stock market crashes and asset bubbles, right? So there's a lot to talk about today. Today is actually probably one of the longer lecture times that we'll have in this class, just because there's a lot to talk about, but hopefully you'll find most of it interesting. So let's begin talking about stocks. And where did stocks come from? Really, if you think about the history of stock markets, they're really predicated on two developments that preceded them. The first is stocks only were invented after the invention of money and bonds, right? Obviously, money needed to be invented because all financial instruments are a way of trading money across time. But bonds actually preceded stocks in development. And that is, and you might ask, well, why do we need stocks if we have bonds? Well, stocks allow for people to trade money in ways that bonds do not, right? For instance, the key difference between a stock and a bond is that stocks allow entrepreneurs to share much more risk with a wider variety of potential investors, right? So when a firm issues a bond, they're not sharing nearly as much risk with the people who buy those bonds as what happens when an investor buys a share of stock, right? When an investor buys a share of stock, the firm is sharing a lot of risk with that investor, right? So stocks really are different ways of not only transferring money across time, but different ways of sharing risk. The second big invention that preceded the development of the stocks was the corporation, right? So a corporation is a legal person that's separate from the owners, right? So the creation of corporations allowed corporations to essentially act as legal persons. They can enter into contracts, they can engage in finance, corporations can own assets, they can pay taxes, but they live forever, unlike you or me. And the invention of the corporation was necessary for shares because because corporations now last forever, you can break up these corporations into small little bits and transfer these ownership, right? And this ownership needs to be transferred. So corporations essentially separated ownership from individuals, right? If you think about a family business, right, that firm is really completely tied to specific individuals. And if those individuals die, the firm probably disappears along with it. That's not true with a corporation, right? We're actual personhood, right, aside from legal personhood, ownership is separated from individuals, and it allows the corporation to last forever, and it allows the ownership of these corporations to be transferred. So when it comes to what makes a stock, oops, I'm sorry, hold on one moment. I thought I had my lecture notes pulled up here. So let me share with you. Here we go. The characteristics of a common stock, right? So a common stock, we will talk about some other forms of stock here in a minute, but for a common stock is a residual claimant, meaning that if the firm would go bankrupt, if you own a share of common stock, all that you get is what's left over after all the other creditors have been paid, which is unlikely to be very much. However, that's the downside of the common stock. The upside is limited liability. If you own a share of common stock and the company goes bankrupt, you cannot sue the individual shareholders in the case that the company runs out of assets to repay all the creditors. Common stocks offer the ability to transfer ownership in small denominations, right? So in other words, you can own tiny little bits of these corporations and trade them. And this is, and so not only does it allow for ownership in small denominations, but it allows it to be transferable. And as we said, that's one of the keys about a corporation, is it basically separates individuals from ownership. What do you get when you buy a share of common stock? Well, first you get to vote for who's on the board. Many corporations register in Delaware. You might have heard of a Delaware corporation, because shareholders have limited rights to vote out directors and exert detailed control. So in the US, most corporations don't give boards of directors a great deal of influence over what's happening. And that, of course, is many reformists, we're not going to get into this in this class, but there's quite a large reform movement in the US related to corporations. And, I think there's actually some very good arguments to be made that the limited rights that shareholders have under Delaware corporations is actually something that the US should be looking at, because it actually, it might fuel a lot of many of the things that we observe in the US that isn't so great, such as out of control CEO pay, right? Because CEOs don't have to worry about shareholders complaining about their salaries. They've actually used this as a way of highly leveraging salaries to much greater extent than we've ever seen before in history. So anyway, just keep that in mind. When you own a share of stock, you get the right to vote for the board, but your actual rights of voting out board directors and exerting detailed control is pretty limited. The final thing to note about a common stock is that you are guaranteed a share of any dividends that are distributed, but there's no guarantee that a firm has to distribute dividends, right? Firms can retain earnings. In other words, choose to keep those dividends and not distribute them. And so, that's a decision that every firm has to make. To what extent are they going to reward their shareholders? And to what extent are they going to retain earnings and maybe invest in projects that they have, or to serve as kind of a protection or insurance? If you want to kind of think more about how equity works, think about this. You are financing your college through essentially loans, right? Many of you are, right? You're essentially using bank loans. Could you finance your education through shares of stock, right? There's an article here that I put in your handouts about funding students with equity instead of debt, right? Funding students with equity instead of debt. So what would that look like? What would that look like? In the 1970s, Yale University actually did this, right? They actually had a program where for every $1,000 you borrowed, you didn't have to pay Yale back interest payments. You just had to give them 4% of your annual income, right? So essentially, Yale was buying equity in you, right? If you turned out not to make very much money, then Yale wouldn't get very much money back from you. And if you turned out to be super rich, then Yale will get more money back for you. Yale was essentially offering to share the risk of your future wealth. That's really an interesting idea, right? And many economists have talked about why this is. Why isn't it that more students are engaged in financing their education through equity as opposed to debt? One of the reasons why likely is moral hazard, right? So you can think about it this way. For these students who borrowed money from Yale, now they have a lot less incentive to make money in the future, right? So who would borrowing through equity be most attractive for? Well, if I knew that I was going to be an elementary school teacher, maybe I'd think, yeah, you know what? I think I will take that equity option because I'm not going to make so much money, and it means I have to pay less back. So that creates some somewhat perverse incentives, right? But thinking about financing your college education through equity, think about this for yourself. Would you take that bet, right? If somebody said that I'll pay for your college, but you give me 10% of your earnings from here on out, do you take that bet? I don't know. It's a really interesting question. But I do think many economists think that students should at least have that option, right? That it seems unusual that students only have the option to take on debt and not borrow through equity. Let's talk really quickly here about stock markets. Stock markets are primarily made up of primary markets and secondary markets. Primary markets, we've talked about this before. This is IPOs, or initial public offerings, done by investment banks who do underwriting, right? Underwriting meaning issuing new shares of equity. In these initial public offerings, who buys in these initial public offerings? Well, usually it's institutional investors. For most IPOs, the public gets relatively small chance to buy into these initial public offerings, right? Usually these initial public offerings are first offered to the big institutional investors who can buy up billions and billions of these. And so usually when a new issue is made, they initially go to institutional investors who then oftentimes will turn around and sell some of their shares in secondary markets, right? Just as with bond markets, secondary markets can either be centralized exchanges, meaning they have a physical location in one place, or they can be over-the-counter markets, OTC markets, meaning that they have no physical location. They're just networks of brokers and dealers. So for instance, the New York Stock Exchange, right, is a centralized exchange where only licensed dealers can make transactions. And the New York Stock Exchange tends to be a little bit more slow and a little bit more costly because of that. NASDAQ, right, is an only electronic market, and it's over the counter, meaning there is no physical location. It's quick, but it's impersonal. And many people have argued that there's really an argument to be made for having licensed dealers make transactions because it's actually a check on making mistakes. I have written here an example of a clerk at a Japanese stock dealer made a typo on his keyboard that cost his firm $340 million when he sold more than 600,000 shares of a company at 1 cent instead of selling one share at 600,000 yen. Those kind of mistakes can happen in electronic markets because they are kind of impersonal, right? And once you hit buy, that offer is out there. How do we keep track of stock markets? Well, usually through stock indices, right? So a stock index is just a bundle of stocks. And this bundle of stocks, you kind of track what happens to the value of this bundle over time. So the Dow Jones Industrial Index, which is probably the most famous stock index, is the 30 largest companies in the United States, right? And it dates back to 1885. Interestingly enough, only one company has been in the Dow Jones since 1885, and that's General Electric. So over time, the companies that are in this are switch out as companies shrink and other companies get bigger. The Dow Jones Industrial Index is actually a very, very bad stock index. By only looking at 30 companies, it's not nearly diversified enough to give you a good picture of what's going on in the entire economy. Likewise, I'll just skip down here to the NASDAQ. The NASDAQ is well, there's a large number of firms in the NASDAQ. It's not a particularly great stock index either because it tends to focus on newer, smaller, technology-intensive firms. Usually when economists want to look at kind of the broadest measure or the best measure of what's happening to the stock market in general, we'll look at the Standard & Poor's 500 index, which is the 500 largest firms in the United States. These 500 largest firms encompass about 85% of the value of the entire stock market. Or sometimes economists will look at the Wilshire 5000, which is really 6,500 companies. This is kind of the broadest look at what's happening to the stock market. I think the Wilshire 5000 gets very close to like 98% of all the stock market value in the United States. These are just the indices in the US. Roughly about a third of all countries in the world have a stock market, and each of these countries have created stock market indices. And so you can get online and look at what's happening to stock markets in Qatar or France, or I don't know if Ecuador has one, but that's a question you can answer online if you were interested in it. Obviously the stock market is followed very closely. Even though firms don't raise the majority of their money through stock markets, people follow this very closely, and in part because the stock market has been an incredible way to generate wealth, right? Since 1950, the S&P has averaged about 10% real growth every year. So if you use the rule of 72, and if you remember the rule of 72, if something grows at G%, it doubles in size every 72 divided by G years. So using the rule of 72, if you put money in the stock market, you double your money about every 7 years, right? Compare that to government bonds, which have only averaged about 2.5% real return, right? So, putting your money in the stock market over the long term has been shown to be the best way of compounding your wealth and taking advantage of the credible growth and over the long term of the U.S. economy. Having said that, we all know that the stock market comes with risk, right? During the Great Depression, stocks fell by 40%. We've seen stocks fall by as much as 22% in one day. During the high-tech bubble of 2000, stocks fell about 30%. During the 2008 crisis, stocks fell by 50%. During the pandemic, stocks fell at their peak at about 33%, right? So, yeah, there's a lot of risk, right? And if you are a person who's living on the money that you make from the stock market, right? If you're a retired person, to think about losing 1/3 of all of your wealth in a period of 1 or 2 weeks is scary, right? It's scary. Mark Twain here said, October, this is one of the particularly dangerous months to speculate in stocks. Others are November, December, January, February, March, April, May, June, July, August, and September, right? And so, you can get hit with a stock market crash at any time. These crashes are not nearly as predictable as what you would think they would be. And we're going to talk about why is it so hard to predict stock prices. And I won't get too far ahead of myself. Let me just say that there's some reasons why predicting stock prices in these crashes is not very easy. Valuing a stock is more difficult than valuing a bond. Why? Because there's more uncertainty associated with stocks than bonds. And that uncertainty really comes down to 3 things here. First, what are the future dividends on a stock? We don't know that. With a bond, you know what the future interest rate payments are going to be. With a stock, you don't know what the future dividends are. They are tied very closely to the profits that the firm generates. And then they're also tied to this question of, will the firm keep retained earnings, or will they distribute all of their profit, right? So you don't know what future dividends are. Second, you don't know how long you're going to hold a stock. Stocks last forever, but you don't. So when you hold a bond, it might have 5 years, 10 years, 20 years to maturity, but there is a date at which you know that you will not be holding the bond anymore. With stocks, it's much more subjective, right? presumably the corporation will last forever, or even if it doesn't, you'd like to think it's going to last for a very long time. And so you have to really think about how long you personally are going to own a stock to be able to kind of assess its value to you. And then the third thing that differs between different stocks is what's the risk of this stock, right? We know that the law of the stock market, this isn't just the law of the stock market, this is the law of finance, that higher risk means higher return, all right? So you have to think about what the risk of a stock is. And the higher the perceived risk, the higher the return you're going to have to get to justify holding that stock. So you have to think about, what does your personal risk preference look like? What does the portfolio of assets that you hold look like? And then you also have to think about things like, what's the default risk of this firm? So these are the three things that you need to know to assess the value of a stock, but these are also three things that you don't know, right? You don't know what the future dividends are going to be. You don't know how long you're going to hold the stock, oftentimes. And you don't know what the true risk of the stock is, so you don't know what the required return. So having said that you don't know these three fundamental things, then the question becomes, how do you assess the value of a stock if you don't know these three things? And that's what we're going to come back to in the second section of lecture today, is theories about how you can actually value the price that you pay for a stock. So back in a moment.